Let me start with something which will be very familiar to you. If you've ever invested in the Indian stock market, you open your Zerodha, Groww, Angel, or any trading app and you go ahead and buy a stock. The order executes immediately. Your app shows that you now start owning that particular share in your portfolio, and psychologically, you feel that you're done. You feel like you're owning the stock. But here's the uncomfortable truth, which most investors do not think about. At that point of time, do you actually own it? The answer is no. Because what you're seeing is a promise, it's not a final ownership. And that gap between I think I own this and legally I actually own this is where today's story begins. Because quietly, without any loud announcements or flashy marketing, the New York Stock Exchange is exploring something that could eventually remove the gap that we just discussed entirely. Today, we are going to talk about the tokenized trading platforms. Let's talk about how markets actually work. Let's take the example of India. When you buy a stock on NSE or BSE, the trade executes immediately, and that's the part you see. But the actual ownership transfer happens later through a process called settlement. Now, until recently, India was T plus 2. Now we are on T plus 1. What do you mean by that? So, it means that if you buy a stock on Monday, the legal ownership gets completed on Tuesday. But why do we have that delay? Because behind the scenes, multiple institutions need to agree about whatever just happened. Your broker records the trade, the exchange records it, clearing corporations step in, depositories like NSDL or CDSL update the Demat ownership, funds and securities move in parallelly. But all of this does not happen atomically. Everyone is keeping their own databases, and the time is used as insurance just in case something goes wrong or if something breaks. Now, here are the key insights. The system is not slow because people are inefficient over here. The real problem is that the architecture itself is old. To understand tokenization, imagine how this works today versus how something like UPI actually works. When you send money via UPI, there is no T plus one. The debit and the credit happens together simultaneously. Either the transaction completes or it does not. Everyone agrees on the final state, which is the transfer of the money from person A to person B instantly. And why? Because the system was designed for real time. It was designed for shared verification. Unfortunately, stock markets were not. How are they designed? They were designed the stock market has evolved a lot over time. They were digitized layer by layer over several decades, starting from paper certificates and then moving to maybe T plus 2, T plus 1. So instead of rebuilding everything from scratch, what the stock markets did was that it kept on adding patches. Tokenization by the New York Stock Exchange is the first serious attempt to rethink that foundation. So now let's try to understand what does tokenization mean in practical terms. Tokenization means that instead of the ownership being updated across half a dozen of systems, the stock itself is represented as a digital token on a shared ledger. It's not a copy, it's not a synthetic instrument, it's the real thing. If you ever worked in software, think of it in this way. Today's stock markets are like multiple microservices with no central source of truth, constantly syncing state with retries and reconciliations across various services. Tokenization introduces a single shared state machine. Whenever the ownership is changing, it only changes once and everyone sees it real time. No waiting, no pending settlements, and no ambiguity whatsoever. Now let's talk about why this matters using examples that hit closer to home. First of all, the market hours. Why does the Indian market hours, the Indian market the Indian stock market shut at 3:30 p.m.? Demand does not vanish after that. News don't stop. Global markets keep moving. Markets close because systems need a downtime to reconcile trades, process settlements, and reset books. If the ownership settlement happens in real time, the constraints start to look artificial. You no longer need them. And that is where the idea of the 24/7 markets come into the picture. That's not really a gimmick, it's a natural outcome of a better infrastructure. Second, let's talk about the settlement risk. At this point of time, huge amounts of money are locked up as margin buffers. Clearing corporations demand this capital because there's a risk that if something goes wrong between trades and settlement, this is invisible to most of the retail investors, but it is very real for institutions. If settlement becomes near instant, which means that the cash and the ownership move together, that is where the risk collapse. And when the risk collapse, the capital gets freed, not for speculation, but for efficiency. That's a system level improvement, not a trader feature. Third is where the fractional ownership comes into picture. Today in India, when you buy fractional shares through apps, it's mostly a broker side abstraction. In fact, in India, that's not even allowed. It's mostly the US brokers which allow you to do that. Somewhere deep inside the system, the whole share is still existing. With tokenization, fractions aren't hacks, they are native, and a share can be split, owned, transferred, and settled cleanly at any granularity whatsoever. This matters a lot in a country like India where high priced stock keeps many people out. And it's not about convenience, but it's about access, it's about liquidity. Now, at this point of time, it's important to clear up a very common misunderstanding. This is not about the cryptos replacing the stock market, or it's not about deregulation, or it's not about that everything is going to be on blockchain tomorrow. Think of it as like Aadhaar or UPI. Those systems didn't remove banks or identity laws. What they did was that they really upgraded the rails which were beneath them. Tokenization is that kind of upgrade. Same stocks, same regulators, and same rules, but just a better system of records. If anything, a shared auditable ledger which makes surveillance and compliance much easier and not hard, much easier. So, why New York Stock Exchange is even thinking about this? Because exchanges everywhere are facing the same pressure. Crypto native platforms have shown what instant settlements look like. Regulators want lower systemic risks, investor wants faster, cheaper access, and technology has finally matured enough to really make this feasible now. Not just feasible, but feasible at scale. If traditional exchanges don't modernize their core infrastructure, they risk becoming just front end interfaces sitting on top of someone else's backend. Tokenization is not really a trend chasing move, but it's actually a survival mode. If this becomes mainstream, the changes won't be loud, but they'll be extremely deep. Exchanges start behaving more like protocol operators, broker focus less on execution and more on advice, access, and trust. Custody becomes about key management and compliance, not proper trails. Clearing, something most investors never really think about, increasingly becomes code. Jobs are not going to disappear, they are just going to evolve. Just like cloud didn't really kill data centers overnight, it just redefined how they worked. And that brings us to the real takeaway for today. The biggest technology shifts don't arrive with fireworks, they arrive quite deep into the infrastructure, changing the constraints which we've accepted as given for so many decades. So tokenization is not because it's not exciting because the trades are going to be faster. It's going to be exciting because the markets start behaving like model digital systems. And this is not the hype, it's the evolution at its core. And once the core changes, the core infrastructure changes, everything built on top eventually follows. Thank you so much for being with us. We'll keep on getting new emerging technology news with you and keep on sharing with you.